Welcome to Business with Beers, a podcast for business owners who want to scale their business to massively grow their income and contribution by investing in people, process, and technology. I am your host, Brian Beers. This week, we've got a great show with Charlie Stevenson from Akras Capital. Akras is a real estate investment company that focuses on multifamily properties. Their mission is to produce financial freedom in the lives of the partners and the investors. In this episode, Charlie and I talk about what is a syndication, the benefits to an investor, what types of financial returns can they expect, and how COVID has changed those. Charlie talks about the importance of being very selective on both the quantitative and the qualitative measures they use to determine what markets they invest in. He shares some gold nuggets on creating a blueprint of standard operating procedures to run the company, which ultimately will provide time freedom for himself and the partners. If you enjoy this episode, please share it with your friends, rate and review with your favorite part to help us reach more people. And if you'd like to learn more about the topics covered in this podcast, check out brianbeers.com to sign up for my free weekly newsletter delivering content directly to your inbox. Welcome to the show, Charlie.
Thank you, Ryan. Good to be here.
Great. Well, this wouldn't be Business with Beers if I didn't ask you, we're at a bar having a cold one. What are you drinking?
Well, I guess the question back at you is, where are we drinking? Are we in Colorado, or are we in, where you are? Or because it's like it's so different from one place to another.
All right. Colorado.
In Colorado. Okay. So favorite beer out here right now, I would say is, there's a brewery local to Boulder where I live called Syndication Brewery, Syndication, and they have a pretty awesome hazy IPA, and I'm a sucker for hazies. So if you were to ask me what my overall favorite beer in the country is, it'd be Heady Topper from Vermont. That's where I was out in Vermont for a while, or in New England anyway. And so I got a taste for that. So I always try to recreate the Heady Topper wherever I go. So
okay, all right. What if I said Key West?
Ooh, I don't know a lot of Florida beers. I think I'd probably go with a Presidente or something. When I get down to the tropics, I want like a lager style with like a lime in it or something. So I'd probably go with like a Spanish or a Caribbean brand.
Perfect. Sounds great. So if you could share your story, who you are, what you do, where you live.
Yeah. So again, my name is Charlie Stevenson. I live in Boulder, Colorado with my wife, and originally I'm from Washington State. Moved to Boulder just a few years ago. I own a business called Akras Capital. We focus on acquiring and operating multifamily assets in inland growth cities. And my career landed me here after kind of a crazy entrepreneurial roller coaster of different types of businesses in different industries. But I'm a big traveler. I'm a big outdoorsman. I love to be skiing and in the mountains, and love to travel. And so when I was in college, started a travel company that took American study abroad students from different parts of Europe to other parts of Europe, or to North Africa or the Caribbean or the Mediterranean. So after graduating from college and doing a little bit of a stint in corporate America, I started an adventure travel company based in Florence, Italy. Ran that for several years, and then started another travel company based in Boston where I went to college, and had a blast doing that, and eventually got back, as businesses, some succeed, some fail. I got back into corporate travel and worked in Boston a bit longer. That's when I met my wife, and she was working in investment management, essentially on Wall Street, but in Boston. And we were both working the corporate grind. We both loved to travel. That's the reason why we liked each other, and said on our honeymoon, we need to take a year off and go travel. And so we both quit our corporate jobs and went and traveled. And we bought some backpacks, spent a bunch of time in Southeast Asia, India, Russia, Northern Europe, all over the place. And while we did that, we rented out our home that was in Boston, right in the city, and made some passive income kind of accidentally. And we're looking at each other one time, riding a train across northern Siberia and Russia, and said, man, if we had 5 more of these things, we could basically retire. It'd be an awesome set of passive income. And our friend who was riding with us said, I've been doing that since 2009. How come you guys haven't been buying multifamilies? And that's when we said, let's combine forces and start a company. And that's what Akras Capital became out of that idea. So we began acquiring small multifamilies in my hometown of Washington State. And after building a small portfolio there, we started buying much larger assets in partnership using a syndication model in inland Florida and Orlando and in Dallas, Fort Worth. And now we acquire primarily in Phoenix, and we also look at the Carolinas. So that's our whole story. We started with just small multis and then jumped to much, much larger ones with the help of teams.
Okay. What did it look like that first couple? Like, what was the progression? Like the multiple duplexes, and then you got kind of a bigger 10, 20 unit, and then it went to big, or what was like the progression of that?
We always started, our original kind of investment policy was to always buy commercial size assets, which was 5 units plus, because we wanted to be evaluating these things based upon net operating income. We wanted to be able to get access to lending that would only be available to commercial borrowers. So we always started with commercial, so 5 units plus. Our first asset was a 5 unit. Our next asset was a 7. The next one was 12. So we kept moving, and then we jumped into took a plunge with a team that we met at a big real estate investing conference and acquired a 324 unit. Wow. 12 to 320.
Yeah.
And then after that was 111 units. And now we look at stuff that's anywhere from 50 units to 250 units. It's kind of like that medium size asset. Yeah.
So 50 is kind of the smallest you would do.
Well, we did 1031 exchange some of those original assets that we bought in Washington into Phoenix, and we bought stuff in that similar size, like 8 to 20 units category. So for our own internal investing, sometimes we'll buy smaller assets if they make sense. But for our kind of bread and butter stuff, 50 units plus is kind of our world.
So for those who don't know, can you define what syndication is? Kind of how does it work, high level?
Sure. Yeah, so syndication is just a technique for acquiring an asset. It can be used to acquire all sorts of stuff. People use it to buy buildings, they use it to buy artwork, they use it to buy all kinds of stuff. But syndicating is essentially bringing experience and money together. That's if you're to define syndication. In multifamily investing, it's very similar. Essentially, you will bring a team of experienced operators. Our team will come in and say, all right, we want to have a small group of folks that can operate this actual asset, everything from the acquisition to underwriting it and asset managing it all the way through disposition, selling it. So you've got a team that does that, and then you want to bring in capital. So maybe that group brings some of its own money from its own internal money, but then you might need a lot more. And so syndicating brings in limited partners who want to passively invest in an asset and have no responsibility in the actual operation of it at all. And that's kind of the bigger syndication of limited partners, bringing them and their capital into the asset as passive investors. And so that's very roughly kind of how it works.
Yep.
We use syndication sometimes. We'll also use joint venture structures. We'll also use tenant and common structures. There's a lot of different structures you can use to acquire an asset. It just really depends upon what makes most sense for that asset, the asset size, et cetera, the raise, all that.
Okay. And then what's a typical timeline of holding an asset if it's a syndication?
Yeah, I would say that the best practice is to underwrite a deal to 5 years. And that's what we typically see our peers doing. That's what we typically do as well. But we have seen that extend a little bit in the last year or so. Some people are saying 5 to 7 or 7 to 10. But it's really deal dependent. Some deals you might syndicate and they only have a couple of year timeline. It really depends upon what does that asset need? What's the time requirement to get it to that point for an exit or whatever it might be. So it's very deal dependent.
Okay. So on the investor side, someone's looking to invest passively, right? Because they don't want to go do it themselves. I guess why would they invest in a syndication maybe versus like a publicly traded REIT or even maybe a DIY? And what are the benefits to them?
So a syndication or investing as a limited partner in a syndication versus some of those other types of securities or some of those other vehicles. It does a couple of things. It gives you more direct access to that team that's doing it. So you're very close to the actual asset in most cases. Whereas with a REIT, it's sort of like a mutual fund of assets. So, it could be an asset class in 50 markets across the United States. And so there's less direct understanding of exactly what you're investing in. Maybe less direct access to the operator and the team that provides investor relations. So it's a closeness to the deal, which in my opinion mitigates risk. So, if you are an LP with a deal with our company, Akras, you can call me up almost anytime, as long as it's business hours. You can connect with myself, the underwriter, the asset manager, and we can answer questions for you. Whereas if you invest in a big REIT, you might have to go through, it's like calling a bank kind of. You might have to go through an administrative process. You might not be able to get someone on the line who's actually an influencer or a manager in the deal. So there's a degree of closeness. There's also that degree of like, kind of more, it's a more laser guided, exactly usually where your capital is going. You can drive by the asset itself and see it. So there's a degree of closeness to the deal that I think is different than other, kind of more asset agnostic vehicles for investment. You mentioned DIY, like doing it yourself. So the biggest opportunity or the biggest benefit of investing in syndication is the passive nature of the investment. You can invest a lot of money and not have to raise a finger except for a couple of times to sign 5 documents, and then you're done. So that's really, really nice. You get, maybe a monthly or a quarterly distribution, plus potentially a nice payout at the end, depending upon how that deal is structured. So there's cash flow coming, and you can deploy a lot of capital into one deal and get a decent amount of ownership. So it's all the benefits of ownership without any of the requirements of lifting fingers, managing tenants, all the work of operating a deal and figuring out what kind of a business plan it needs, which is what a DI, if you're to do it yourself and get a fix and flip or buy a 5-unit or a 4-unit, you certainly can do that. It's a huge amount of work. I know from direct experience, I've been very, very involved with my hands, on a project that requires a ton of work. Even if you think it's going to run really smoothly, stuff doesn't. So having a team that knows how to do that and set systems and processes up so it does is really a great benefit to have. Okay.
And what type of return, and I know every deal is different, but what type of return, if it's the first syndication, are they looking at? And I guess there's cash on cash, right? There's an IRR, which is a more complicated formula. And then some simply look, I think, at an equity multiple to say, hey, I give you $100,000. How much are you going to give me back in how much time, right? So your thoughts on that?
Yeah, there's a lot of different ways to measure performance of an asset, and there's a lot of different ways to measure a return profile. And the simplest, I think, for people to understand, the equity multiple is a really simple tool to understand. Like you said, if it's a 2.0 equity multiple, that means you put in $100,000, you get $200,000 back. If it's a 50, a 0.5 equity multiple, you put in $100,000, you're going to get $150,000 back. So that's really easy, I think, to understand. Whereas, you start messing around with cash on cash or internal rate of return, IRR, or annual average return, and those can all be a little bit more complicated for the kind of original or novice investor. I would say the next best return metric to look at is cash on cash return. That's the return you're going to earn based upon the actual cash that you invest. And that's really easy to peg against an investment in another vehicle or another entity or another stock, like a stock market or mutual fund like that. So, if the cash on cash is 8 or 9%, that's better than a 4 or 5% that you typically see in the stock market. So cash on cash and the equity multiple, I think, are 2 really good numbers. When you get to annual average return, that's essentially just the equity multiple divided by the length of the deal. So you can really easily kind of figure that out. But a lot of times, when you get into IRR, you're taking into account net present value and the time value of money. And so it starts to get a little more complicated. That's where you have an adjustment for inflation. So anyway, there's a lot of different ways to look at it. I would just say start with cash on cash return and the equity multiple. And if you need to see what you're going to make on a yearly basis, multiply that and you'll figure out what your annual average return is. IRR, just,
don't worry about that one for now.
Take it or leave it. You asked about what are people looking for right now? So it's changed a lot. I just wrote an article about this just last week. Last year and pre-COVID, we were usually targeting between a 16 and 20% annual average return and a 1.85 to 2.1 equity multiple. That was our target pre-COVID.
For your investors, what you're delivering to them.
Yeah, for what we're delivering to them, what we're also delivering to ourselves. And so kind of what our peers were at on average delivering for a kind of run-of-the-mill multifamily reposition project. So That was kind of in a growing market. So that was the return profile
Pre-COVID.
Before. COVID happened. Money sat on the sidelines. Deal flow sat on the sidelines because people didn't want to sell. They didn't know what was going to happen. And so demand continued to increase because more and more capital piled up as investors were like, I'm still making money and I need to put it somewhere. And deal flow was still zero to very little. So then as those deals started to trickle out and it showed that the economy, the fundamentals of the economy were still quite strong and the government was continuing to stimulate the economy and it didn't look like people were going to lose their shirts if they made it, were in particular industries, all of a sudden those deals started to come back out and the sellers were extremely confident because they're feeling good about the economy. They also know there's a ton of money out there that needs to be deployed. So they started putting their multifamily assets out there at higher than pre-COVID levels. And as they marketed them, they would even increase their expectation for what they would get. So price guidance would come out from the brokerage networks at 15 million for a deal. And then 3 weeks later, it had creeped up to 16 or 17 or even 18. And then it gets bid up to 19. And all the value, investable value has been squeezed out. Because of those forces, which are very real, I would say that the average returns have actually compressed quite a bit. And they've also followed what the Treasury does. So not to get too complicated here, but Treasury returns, which is the government, it's one of the most safe forms of investment and the safest, most peggable return. The 10-year Treasury has gone down to 1.5%, and it used to be a bit higher. And as that goes down, general returns tend to correlate
because interest rates come down and then cap rates come down because they're all tied together, right?
It's all
pegged together. Yep.
It's all correlated. So as all that stuff goes down, so does the return for a typical multifamily investor. And so while this is still a safe haven for investing, and we still think it's one of the strongest asset classes, that also goes with it. And so we're now saying that investors probably need to set their expectations somewhere between, a cash on cash return somewhere of like 6 to 9%, which is actually kind of where it was before. Like 8 to 9% was the cash on cash that we always, and a annual average return somewhere between 10 or 14%. So that's come down a bit. And equity multiples anywhere from 1.8 or 1.9. So you've seen a drop, but ultimately it's still a great place to invest. It's still a great return relative to the Treasury, which more sophisticated and more mature and use that as their peg. To traditional retail investors who were really excited about 20% plus, returns, aren't going to be happy. But frankly, the only stuff they're going to stuff that's being artificially inflated in terms of return profiles, and you got to be careful around that stuff because there's still peers of mine, operators out there that are promoting 20% IRR and 20 to 30% return on these deals, and you just got to be really.
So you said the market's tough to find. How do you go then about finding through off-market relationships? Is that the primary source?
Yeah, so we have traditional relationships with deal providers like brokers in the larger, brokerage houses like CBRE, Marcus and Millichap. And as you get to know those folks, they tend to start showing you their deals before they actually are presented to the marketplace. And so that's typically where we find those types of deals. We also get a little bit more creative with deal sourcing. We go to places like wholesalers who typically find smaller assets, but every once in a while, they might come across a seller who's like, oh, I thought you guys only, wanted my duplexes and triplexes and crummy single families. Well, I also have a 35 unit or I have a 50 unit or a 75 unit that happens to be in my family and you're my guy right now. So why don't we just try it here? They can quickly close, they can bring capital quickly. So, so we do find that wholesalers sometimes find deals like that.
I think you don't think to look, right? Because they're normally playing in the small single family, but you're right. In a couple single families and that guy may also own a apartment down the street. So
exactly. So that's one place we look. Other than that, we create, teams that we co-GP deals on and extend our geographic focus a little bit, and that expands our deal flow. So we find markets that look like the types of markets we like, inland growth markets. And then over the period of a year or two, we'll build a relationship with an operator like us in that along with. And over time, once we've built some trust, we start sharing deal flow and bandwidth increases on both sides in that regard. So that's another thing that we do just to encourage.
So if that person, so you find a market, like you said you're in Orlando.
Yeah, we do have an asset in Orlando. We actually are not encouraging deal flow in that market right now.
Okay. All right. Well, in the past, another market that you are. So you find an operator, and then what's that team partnership look like? Then he's kind of the operator, and then you're helping kind of bring capital. Like, how does that new relationship work?
It all depends upon the deal. Typically, we have a policy essentially within our organization that says that we in any deal that we're involved in, we need to be a co-GP and have a very high level of involvement in any deal from deal provision to disposition. So we get involved very early on in say it's with a partner that is outside of our main focus market, where they have the deal provision network, they have the brokerage relationships, et cetera. As they encourage deal flow, they share it with us. We underwrite it maybe even first, or we co-underwrite it in parallel to make sure that it matches our needs and it actually has investable value. And then we'll get in and usually the team on the ground in that market would be the folks that would do the inspections and probably run the business plan from a construction perspective or of a remodeling perspective. But we'll get involved with asset management. We'll get involved with capital raising, of course. As would they. We would share basically a lot of the responsibilities based upon core competency. So It's very deal dependent and very market dependent, but we don't get involved just as capital raisers. We everything are operators. Yeah.
But if someone had a deal in one of your target cities that they found it, but they don't know what to do with it, or it's a little bit over their head, could they bring that to you and then they would be part of it?
Yeah, so long as that market matches our criteria for investment. We have 6 quantitative criteria and 15 qualitative criteria. Matches those criteria in a certain way, and it's data proven, data driven, then certainly we could come in and say, yes, you've got a 75 unit, you're not really sure exactly how to develop the business plan or underwrite this thing or capitalize it, or what does that capital stack look like? We could certainly come in and support that team that's growing with that skill set and those core competencies, and then co-GP on it and run the deal. Absolutely.
Okay. What are those 6 things that you look for in a market? You mentioned inland, right?
So geographic location actually is one of the qualitative criteria. So the quantitative criteria are population size, population growth, rent growth, median income. Did I say job growth? No, I don't think so. Yeah. Job growth and unemployment. So those are the 6 key figures that we look at. And once those boxes are checked, then we go into a whole host of qualitative things like, it's inland. Is it likely to get hit by major natural disasters? Is it got a high quality of living? That's a really important one. Is it nice to live there? Is it a pretty city? Is it big enough to support a cultural scene? There's a whole bunch of things. Where does it stack up on US News and World Reports, top places to live? Are retirees moving there, et cetera? So there's all these different things we look at. And if it checks, a decent number of those boxes plus basically 5 of the 6 other quantitative criteria, then that's very interesting to us. Yeah.
How many of those? A few
cities that do that.
Yeah, how many do you have now identified that meet that?
3.
Okay. Yeah. Do you have others that are on your radar? You just haven't found a deal yet? To the 3 that are the focus?
Those are our focus. I mean, we could certainly go and find there's other markets out there for sure that would meet those criteria. But we try to stay as focused as possible. And that's just the best way that we can ensure that we're taking care of the assets and taking care of our investors ultimately. So we try not to spread ourselves too thin. We're a small team, 3 partners, so.
Yeah. So multi-family investing, can you speak to, I guess, the team that's part of your company, and then I guess maybe the third party guys that maybe you work with as well?
Sure. So Yeah, our team is made up of three partners. I've got my main focus is we're all full-time real estate professionals, full-time investors, and my role is business. I've got that entrepreneurial background, so business is and general strategy, plus the capital raising and the investor relations, kind of anything that's external facing related to our brand and our messaging is my world. My other two partners, they cut their teeth on Wall Street in Boston, New York. So one of them was a corporate bond trader and a trader on Wall Street. So she's our acquisitions. She's corporate acquisitions officer. So she makes sure that we're encouraging deal flow. She's the tip of the strategic spear from an underwriting perspective in most cases in our target markets, and then negotiates, essentially puts together all of the kind of acquisition side of the business plan. Is also my wife, and she also was a chartered financial analyst, but her focus was on portfolio management. So she was a mortgage-backed security specialist and fixed income specialist in Wall Street. And so her world is portfolio management, asset management, managing the property managers. So she makes sure that the business plan actually gets executed, which is extremely detail-oriented, requires a really vast kind of skill set. And so I'm happy to have her. I'm like a really broad, big picture, like,
that's how I am.
I know enough information to be dangerous.
Yep. Yeah. I'm the same way.
The really serious stuff. Yeah.
Yeah. My brother's he's good with all the numbers and the admin and the follow through and the all the check boxes. I'm more like you with the and probably more external facing and strategy and big picture. So
sounds about the same division of labor. Yeah. So that's what makes up our core team. We also have a marketing communications associate who supports us with, developing the newsletter, sending investor relations communications, putting together marketing packages, things like that, posting on social media if we need to do that. So that kind of thing. And then you talked about third party, which there's a whole host of third party vendors like property managers, inspectors, insurance, lending. There's a ton of third party folks that mostly the asset manager manages those relationships. So Christina does. And then in terms of other partners, those are other operating teams, just like ours, that are usually 2 to 3 folks who split up somehow, deal finding, asset management, and capital raising.
Okay. So you had mentioned, a lot of these syndication deals, 5 to 7 years kind of hold time. This is like an active business of, flipping them in a sense, right? You're buying it with the intention of selling it. That's really where both you and then the investors make their money. What about like personally for a more of a long-term hold strategy? What's your portfolio look like, or what are you looking for? Kind of where do you park?
Our main thesis is to hold. So even though we will underwrite to a 5-year period, oftentimes that would mean that we would, at that point, either keep investors in the deal, or we would buy them out essentially of the deal and pull the equity out. So we do like to hold our assets. Okay. And with our own personal strategy, our own kind of wanting our own, assets into other assets in different markets, like that's definitely a hold strategy. So that said, that's our preference is to hold for the cash flow and for ultimately the appreciation. But if an opportunity exists for an exit and we need capital to deploy into investment capital, then we will do that. So it's not like we're rigidly stuck in that exit. It's really important when you're looking at assets to have a few different exits that you can employ based upon market condition and market cycle. So always keeping an eye out for opportunities. Like the 3 assets that we sold in Washington at the end of COVID, or not the end of COVID, COVID's not over, but in the end of financial
the shutdowns.
20, the shutdowns, those all sold, but a huge opportunity came up and we said, well, let's sell these things. And then we, redeployed that capital. Okay.
So if you wanted to buy out a group of investors to, hold it internally, how do you go about funding that? Do you get a loan against the property to then buy them out, or what is that like mechanically?
It's a great question. And
right, because there's other guys who don't want to get out. You can't take debt on the building because it's your debt, right? Personally, right? Yeah. Their shares. Probably yet. So maybe it's premature, but
it's definitely a little bit more of a complicated maneuver. And there's a couple different ways to do it. And I would have to absolutely default to, actually, like I said, I know enough to be dangerous.
Okay.
Certainly taking out financing, can be one way to at that new higher appreciated value is one way to, all of a sudden bring a bunch of capital that you can use to buy out the investors. As long as you buy them out and make, ultimately they're going to be happy with that outcome. So if you can figure out a way to do that, some could potentially stay in the deal, different ways to do it. But in terms of the specific mechanics, I'll invite my partner Lin Yang onto the program, and she can get into the nitty gritties in that.
Fantastic. Hey, so I want to question about your goals. Having clarity around your goals is kind of critical for achieving success. What are some of your kind of big vision goals of where you want to take your company?
Yeah, that's a good question. I think, we're both in GoBundance. We are big goal setting guys, and that, I think really is a big part of my life. And our ultimate goal within our organization is fairly qualitative. It is to create freedom in the lives of our partners and our investors, which sounds maybe kind of wishy-washy, but it's a really significant reason why we started this organization. And every single time we have a quarterly strategic offsite, we reapproach that. And sometimes even sooner than that. Are we producing freedom for our lives? If the three of us can't say, and for our investors, if the three of us can't say, yes, we are making some materially beneficial impact on our freedom in our lives to be able to travel, spend time with family, feel relaxed at work, feel encouraged by the work that we're doing, then we stop everything and we say, what do we need to do to fill that gap? So ultimately our goal is to produce freedom in our lives. And that looks like, first and foremost, financial security and financial freedom to be able to do whatever we want with our time, and have a business that has enough systems and processes in place such that it'll run with eventually minimal impact from the partnership. So we are building a robust set of systems and a team so this thing runs like a really well-oiled machine, so that we can continue to be involved in it, but also rest assured that with confidence and with consistency, it produces value every single quarter. So building the system of our business, the little engine to produce freedom for our lives and the lives of our investors, is our ultimate that's the drum that we're constantly beating. There are certainly revenue targets that are related to that for us personally and for our investors. So we have revenue targets and units, kind of assets under management targets in our different markets. But I won't get into all the specifics of that. But we have big aspirations for growth and scaling without getting so big that this thing turns into a corporation that has all of the administrative trappings of large corporations that us three partners have all worked in. We just don't want to get there. We don't ever want to get to that place. Yeah.
So you mentioned having a number of those processes. We all have the same 168 hours a week. What are some of those processes or things you're doing to give you, there's time freedom, there's geographical freedom, there's relationship freedom. There's all these freedoms. That's what you mentioned. What are some of the processes that you've either put in place or you're working on to be able to leverage that? Yeah.
So I'd say first and foremost, it's putting systems in place and processes in place that really organize communication within our organization, so that we have all the information we need to be making smart choices and decisions. And these are processes and systems like weekly standing meetings, communication tools, tools to manage workflow, also processes and systems, literally like written up documents, standard operating procedures for how to conduct due diligence on a deal, how to encourage deal flow within a market. Literally step by step. Like if I gave it to you tomorrow, you could read it and say, oh, this is how the Akras team does it. And the reason we do that is so that as we grow our team and bring on more partners or more full-time employees, we can give them those documents. They can read it and say, okay, this is where I start. I first log into ActiveCampaign and I go and I see who are my broker relationships in Phoenix. Okay, well, let's go in there and I can see all the notes and all the information related to that individual and kind of pick up the conversation from there. So, everything is systematized to a point of like militant. I won't say militant because we have fun. Freedom is our world. But we're very, very diligent about that kind of stuff.
And that's how you then scale. Like you said, you bring in new people. Here's the playbook of how to do everything. And then you don't have to walk them through step by step because you've got it all written. Do you guys follow Traction, EOS?
Yeah, a little bit. And we use some of the same ideas like disciplines for execution.
40X,
Yeah, we use, I think the fundamental book that I was given by one of my mentors back when I started into the entrepreneurial world in 2005 was a book called The E-Myth, Revisited by Michael Gerber. If you're an entrepreneur or an aspiring entrepreneur or have your own business and you don't have those ideas in mind, this could be a game changer. So definitely pick that book up. It's kind of our manual and we use it to systematize our business. Okay. The other thing I think I would say is really get clear and aware of what work you should be doing as the entrepreneur leader and what work you shouldn't really be doing. Like there's another great book out there that my whole team has adopted and the ideas that my team has adopted called Deep Work by Cal Newport. And that helps you to identify deep work versus shallow work. Deep work meaning work that you do that really produces something new, real value in the world. Shallow work being all the administrative stuff that might support that deep work. It's busy work, And so identifying those two things and parsing them out, making sure you're setting time aside for deep work that's not distracted and that you have systems and processes to either eliminate or mitigate the shallow work and or outsource the shallow work so that you just can be really
otherwise fun. It's like a tidal wave that pulls you in and then your whole day goes out the window and you got nothing
done. Like a pinball machine is what I feel like. If I don't have that stuff identified and grouped, I feel like a pinball machine and nothing actually gets done. I just feel stressed out by the end of the day. I want to be able to like unplug at 5:30 and just recharge my brain for the next day, enjoy time with my family, enjoy time in the mountains where I live. If I don't do that, then I'm not happy. I don't have freedom in my life, ultimately.
Yep. Awesome. So where can listeners connect and find out more about you and your company?
Yeah. You can find all sorts of resources and ways to connect with myself and my partners and my team at our website, which is www.akrascapital.com, which is AKRAS capital.com. We have an ebook there. We have a contact form. We have investor applications. If you're looking at deploying capital as a limited partner or even as an active partner, if you're looking to partner with us, get in touch with us. We'll love to have a conversation with you. You can book a meeting with me directly through my Calendly link on that website. So akrascapital.com. You can also send me an email at cstevenson@akrascapital.com. I'm pretty approachable. Just keep an eye on it. We have a digital presence on all the different social media places and we have a newsletter. So sign up for that. Lots of different ways to connect.
Awesome. Cool. Thanks for coming on and sharing your story and everything about syndication. I think, you added a lot of value here. So appreciate it.
Thanks, Brian. Yeah, I appreciate you. Thanks for putting this together. And good luck with, beers, Brian, with beers as it grows. Appreciate it.
Yep. There you go. Business with beers.
Business with beers. There it is. All right. Cheers. Thanks, man. Appreciate it.
Yep.